Hey folks, David Frost, mystrategicforecast.com. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, August 5th, 2014. Here's a chart of the SPY, but before we get into that, I want to just make mention of some questions I got from people around, people I talked to during the day or after the market closed today, even neighbors, for example. Why was the market down, they want to know. Well, everybody wants to know why the market was down. Sometimes I want to know why the market was up when it looks like it should be down. So it's just a funny question. Why was the market down? The answer I like to give sometimes is, well, there was more buyers than sellers. And then they pause for a second and say, ha ha, they think that's funny. But in reality, the media wanted you to think that the market was down today, for example, because of Russia. Russia's going to invade Ukraine. Newsflash, Russia was invading Ukraine months ago. Okay, they've been invading Ukraine. They took part of Ukraine. So that's not new news. By the way, Monday they were assembling troops on the border as reported by the news, and yesterday, where were they, right? They were still on the border. Today, all of a sudden, they're invading Ukraine. Yesterday, the market was up, so they forgot about it. Today, the market was down. They pulled a reason out of their hat. Okay. There was also another reason I noticed that came out late in the day. The banks are undercapitalized, and that's the reason the market was down today. Well, if that's the reason the market was down today, how come the news came out after the fact? That's not the reason the market was down. The reason the market was down is because the cycle is taking hold. Okay, the cycle that I've been discussing for a long time now that basically turned around the third week in July, like I was saying it would, okay? The cycle is taking hold, and now the pressure's on the downside. We're in a bear market. Whether anybody wants to realize that, talk about it, admit it, or whatever, we're in a bear market. So the point is that now, remember those days recently and for the last few years when no news was good news, bad news was good news was good news, sideways news was good news? Those days are over. Now, bad news is bad news, and good news, if you're lucky, you might get an up day or two, okay? But for now, the pressure's going to be on the downside, okay? And I take that back. You're going to see plenty of, multiple up days to relieve some of the selling pressure over the next few months. You'll see weeks of up moves. You'll see bounces along the way. Nothing goes in a straight line, folks. You're not going to go from 1900 on the S&P down to 1700 by Friday. It just doesn't work that way. Now, could it happen? Yeah, of course it could happen in an all-out collapse. But in reality, traditionally, the way the market works is it's going to work its way down. It's going to have some big down moves. It's going to have some big up moves in the middle. And that's there to trick you. It's there to push out the shorts. It's there to relieve the selling pressure. It's there to relieve the oversold conditions. And then the market will sell again when it gets overbought and when it gets to levels, technical levels. Speaking of which, let's take a look at a technical level. So the market came down today, and it was pretty good selling pressure. There was nice volume today, and it was considerably more than yesterday. And when there's higher volume on a down day, that's real selling pressure, and that's the institutions selling. That's the mutual funds, the hedge funds, the pension funds, any fund you can think of. It's the big guys selling, right? This isn't mom and pop selling 100 shares of Exxon from their E-Trade account. That's not what pushes the market down, okay? So you're having this selling pressure, and you had the short pause only 2 days ago, and you had an up move yesterday, and then right back down, and you came below the low from the other day, but you closed above it. So the jury's out. There's one scenario. Well, let me take a look at a technical level again. I know I drew this in last night. Let's look at a Fibonacci retracement from April to the high from a couple of weeks ago. And here was your 382 that we closed on the other day, on Friday. Okay, now we're working our way down to the 50, which is around, we'll call it 190, which coincides with this gap fill here. That's a good level, okay? And then you have the 618, which is, there's a ton of support in here. All this chopping around for weeks, this is going to act as very good support. So the 618 along this level here is great support, and then you have the 200 here. So, it depends on how the market comes into these levels. If you consolidate above these levels for 4, 5, 6 days, then they don't mean as much. But if you come straight into one, like for example, if we came down hard tomorrow and went down, let's say 20 points on the S&P, or $2 on the SPY, came down to here, I would say you would expect a snapback also tomorrow to relieve some of that pressure, and also because the 50% retracement, the Fibonacci retracement, is meaningful, and I would suspect that that would at least hold for a day or so, and maybe even 2 or 3. So that's one possibility. Another possibility is a really, really big flush tomorrow, maybe 4 points on the SPY or 40 points on the S&P, come into the 618, and then I would say you definitely get a snapback because of all this support here, and it's just a large move, and I would say that the market's already oversold, so you're going to need to relieve some of the selling pressure before you can have another big wave down. But for the fact that some of the largest down moves in history have come from oversold conditions. So that's one thing you have to be aware of. Don't get cute with the market and try and pick bottoms and things like that on your own, because if the market it's like a rubber band, right? So you have a rubber band and you're stretching it, and then just when it gets to the point where it can't stretch enough, it usually snaps back, right? You let go and it snaps back. But if you pull it just a little bit farther, right at the point of inflection, it can snap. And that's what the market can do, and it's done it in the past, okay? It did it a couple of times in '08, and it also did it in 1987, and it did it between 2000 and 2002, and that's what makes markets go down 50% when you get those kind of oversold snap declines. And we may see some of that. I don't know that we'll see it this week, but we're going to see some of that over the next couple of months. Mark my words on that one. All right, let's just flip over to an hourly chart here of the S&P or the SPY, and just to see what we see. So what you have here is this big wide range red bar here from this afternoon. And you basically couldn't do anything with that, couldn't recapture, but maybe just for a couple of minutes you recaptured, not even half of that move. Now that shows weakness, so I would suspect there's more weakness tomorrow morning. And I like, if I had to make up a scenario for the rest of the week, okay, my preferred scenario would be, now I'm not saying this is going to happen, I'm just saying if I think this is happening, it's something to play. If you see a kind of a throw up in the morning and there's bad news at the open and the market starts down and it gaps down at the open and it goes farther down, I would say the market would find some support, just like we talked about on the daily chart over here, okay? Find some support in one of these two areas here, and then if we found some support, around, let's say, late morning, okay, that may be a recipe for some long trades, and I've got some stocks on the radar screen to issue some long trades for the members. So if I see that scenario, I think we're going to take that opportunity and run with it, because those are the things that swing trading is made of, and that's what we do here. We issue those type of trades for our members, and I could have as many as 3 or 4 of them, and some of them will take all of them, and some of them pick and choose, and that's fine. That's up to the individual. I provide educational information, and you guys make decisions on how you want to operate your own trading and investment account. That's the way we play it here. All right, so I got a little long-winded on the S&P chart or the SPY chart, so let's just run over some other stuff. Here's gold, more of the same today. Gold was down slightly today. GLD was down 12 cents, no big deal. I still say that this gap fill comes into play 122.5, 122, 123, in that neighborhood, looking for that. And I'm looking for that in days, not weeks, but days. And then if you look at GDX, okay, it's even better. GDX is still above the neckline of the inverse head and shoulders that I like to talk about, and I just think there's $10 on the upside in GDX. So same thing, when gold's ready to take off, GDX is going to take off with it, and that's going to be not only a good trade for GDX, but it's going to be a wonderful trade and even better for some of the gold mining stocks that I'm going to put out to the members, because if GDX goes up, what's $10 on GDX? It's basically that could be up to 40%. If GDX goes up that much, okay, then some of the gold mining stocks can even go up more. Because what's in GDX? GDX is made up of the larger gold mining stocks, but it's made up of a basket of stocks, right? So if you take some of the individual stocks with the chart patterns set up for a larger move, and that's the value of knowing how to read the charts, and you basically, you want to pick the ones that have the most strength, the most relative strength to the rest of the sector. And that's where you make the most money. So that's what we're going to do for the members. Give them the 3 or 4 gold mining stocks that have the best trade setups, and forget 38, 40% on GDX. How about 60, 70% in some of the gold miners if they really run hard? All right, let's move over to oil real quick. Oil had another rough day. And I got to tell you, oil does not look healthy. And it's interesting because with all the stuff going on around the world, you have this group, ISIS in Iraq, that's moving towards Baghdad. I think they took over a refinery. I mean, nobody's talking about that, or at least nobody. I'm not hearing any of that stuff as it relates to the financial news and how that can impact the energy markets or anything like that. And maybe it won't, maybe it will, but it's usually talked about. You have the Ukraine and Russia situation. And you have hurricane season upon us. All of a sudden, oil is melting away, and it just, something doesn't smell right. So I'm watching that, and normally oil should be higher based on what's going on and where it's been just several weeks ago. So I'm suspect it can go lower. I said that the last few days. I don't think the 200 is the buy. I think it's lower. And if we bring up a weekly chart, and I'll just show you what I'm looking at. Okay, on a weekly chart, I'm looking down in this area here for to pick up some USO, and let me just show you one of the reasons why. Okay, let's go back. Wrong tool. Let's go back to the Fibonacci retracements. Okay, and we go from low to high, and here's your 618 at $34. Okay, so that's what I'm looking at, and why am I looking at that? Only because of this real big red bar here, which is a huge down week. Okay, and if we consolidate, well, hold on a second, guy. I'm sorry about that. If we consolidate for a few more weeks like this, okay, I think we come all the way down to the 618. If we consolidate this close to the 50. Only $1 or so away from the 50% retracement, I don't think it becomes a stopping point. I think, of course, the longer we consolidate, the lower it's going to go. But that's kind of what I envision playing out here. Or you can just see another move into it, or maybe not. I could be wrong, but I feel like there's something wrong in the oil or energy complex. And under normal circumstances, I would expect higher prices, and that's why I'm taking this stance. Last thing we'll look at tonight is the VIX. I like to look at the VIX when it's on the move with you guys. And this is the weekly move, huge move last week, of course. And what you could be putting in a sideways pattern here that could move higher prices. And if you get higher prices, let's take a look at where we would go from here. Of course, if the market goes down, you're going to get higher prices in the VIX. So where are we looking? So we're looking at some of these levels here. Okay, we're looking to get to 20. Okay, that's 2021. That's going to be a big level. There's going to be a lot of resistance. With this top, this one close by, this one close by. This 2021 level is going to be a ton of resistance. And then you're going to get up to this 23.5 area, 23.27 here from this high. It's exactly 23.23. That's going to be another huge level of resistance. So those are your levels, but you're not going to just go up there in one shot. But you can get up there on a spike. If the market really dumps out one day, you can go up $5-6 on the VIX. We've seen that before. We'll see it again. You saw it here. You saw it here. You saw it come down that much. All these big moves. Look at this move down. So that is going to happen at some point. So I just want to let you know this. By the way, for those of you that don't know, what is the VIX? The VIX is the level of volatility in the S&P measured by the option market. So the more people that are buying puts over calls raises the price of the VIX, or raises volatility. How do you play the VIX? Well, some folks like to play the VXX. Don't play the VXX because it's a really, really bad product. It just doesn't really track the VIX. When the VIX goes up, the VXX goes up. But when the VIX is in a downtrend, like when the markets are going up, it really melts away and you lose. It has what they call slippage in some of those ETFs, and it loses more value than the VIX is losing on a daily basis. So just be careful with something like that. If you want to play the VIX, you can buy puts and calls on the VIX, and that's really the best way to play it, barring, the VXX. I just don't like that play. Anyway, long-winded tonight. It's a lot of information, but the market's heating up, so I want to try and give you everything that's on my mind so you can be prepared to be successful in these markets. And the members have been in some great short trades that are coming into first level of support, so we're going to look to take some of the profits off the table, and they'll know what to do from there. So other than that, folks, I'm David Frost, MyStrategicForecast.com. Thanks for tuning in to another episode of Common Sense Market Analysis.